Warren Buffett, who's arguably the greatest value investor of all time, has an $18.6 billion investment in Chevron. It is currently his fifth biggest holding, making up 6% of his Berkshire Hathaway portfolio. The stock is down over 21% from its 52-week high in January 2023 and is currently trading lower than Buffett's largest purchase made in 2022. So is now the right time to buy into Chevron and invest alongside Buffett, or is there more pain to come in 2024? In this video, we will answer this question by analyzing the Chevron stock, reviewing important financial metrics, comparing the stock's performance against competitors, and assessing the stock's dividend safety. By the end of the video, we will run the numbers through our valuation model, deciding on an acceptable buy price, and I'll also share with you my strategy and what I've been doing with Chevron in my own portfolio. Before commencing our analysis, I first want to welcome you all to Investopia, where we discuss everything finance. I also want to share a friendly disclaimer. Please remember that this is not financial or investment advice, and that you should always do your own due diligence and make decisions based on your own circumstances. With that being said, let's get right into it. Chevron is the second largest oil and gas company in the United States and the third largest globally, producing over 3 million barrels of oil equivalents per day. It is fully integrated, meaning that it's involved in the entire value chain of the oil industry, from the exploration and production of oil and gas to the distribution and sale of petroleum products to end users. Chevron is a mega cap company with a market cap of $277 billion. It is trading at a price to earnings ratio of 10.95 and has a nice dividend yield of 4.1%. Looking at the stock's performance over the last 5 years versus the S&P 500, we can see that Chevron has significantly lagged the S&P, increasing only 29% since January 2019, while the S&P increased 79%. Now, when comparing Chevron's performance with its competitors, ExxonMobil, Shell, TotalEnergies, and ConocoPhillips, we see that Chevron's 29% return comes right in the middle of the batch. ConocoPhillips and ExxonMobil outperformed with returns of 65% and 37%, while TotalEnergies and Shell lagged behind, increasing only 22% and 4% respectively. Moving on to Chevron's financial statements, we can see that revenues grew from $158.9 billion in 2018 to $202.5 billion in the trailing 12 months. That's a CAGR, or an average annual growth rate, of 6.2%. Similarly, we can see that net income increased from $14.8 billion in 2018 to $25.4 billion, which is a healthy CAGR of 14.4%. However, if we take a closer look, we'll find that the growth of both revenue and net income is not consistent year to year. For example, you'll notice that both amounts declined sharply in 2020, with net income actually going negative, while 2022 presented their highest levels in this 5-year period. So, what is the reason behind these strong fluctuations? Well, this is mainly due to the cyclicality of the oil industry and its strong correlation with oil prices. Looking at the prices of oil in the same time period, we can see that oil prices bottomed in 2020 during the pandemic and topped in 2022, perfectly matching the pattern that we just observed in Chevron's revenue and income. As for the balance sheet, we see that the cash balance in 2018 was $10.3 billion and decreased to $5.9 billion in the trailing 12 months. However, we do see that current assets, which also includes the cash balance, increased from $34 billion to $41.7 billion, which is a 5.2% annual growth rate. Net debt, which is the sum of short and long-term debt minus cash and cash equivalents, decreased from $24.1 to $14.6 billion. That is an average decrease of 11.7% per year. So, although the cash balance is decreasing, current assets as a whole are increasing, and net debt is decreasing at a somewhat equal rate. Considering that Chevron operates in a capital-intensive industry, its balance sheet actually looks good. In terms of the dividend, Chevron has a dividend safety score of 90 out of 100, which gives it a very safe rating and means that a dividend cut is highly unlikely. It has an outstanding streak of paying dividends every single year for 111 years without a reduction, and has been increasing the dividend for the past 35 years, making it a dividend aristocrat. The dividend has been increasing on average 6% in the last 5 years and 7% in the last 20 years, with the latest increase coming at 6.3% in January 2023. As we can see here, Chevron's dividend yield of 4.1% is slightly higher than its 5-year average of 4.04%, which could possibly indicate undervaluation. Similarly, Chevron's forward PE also indicates undervaluation, with a forward PE ratio of 11.6 versus its 5-year average of 12.7. As always, we should not look at any metrics in isolation, and we will only make conclusions by the end of the video. Chevron's earning payout ratio is currently 43%, which is lower than our preferred 60% threshold. We generally want it to be 60% as it gives the company space to continue increasing the dividend in the future. As always, I personally prefer to use the free cash flow payout ratio, as the earnings payout ratio can be subject to accounting manipulation. Again, anything under 60% is our preference, and as we can see here, Chevron's free cash flow payout ratio is currently 55% and expected to drop to 49% in 2024. Now, given the cyclicality of Chevron's operations, you could possibly consider a lower threshold if you believe that oil prices will drop or stay at low levels in the next few years. Moving on, we see that earnings per share and free cash flow per share have increased since 2013. However, we do see the same fluctuations that we observed with revenue and income. Shares outstanding have been relatively flat since 2013, so Chevron hasn't really been buying back shares. One thing worth mentioning though, from Chevron's 2023 investor presentation, is their forward guidance regarding share buybacks. As you can see here, Chevron is expecting to buy back $10 to $20 billion of their shares outstanding, which equates to approximately 3 to 6%. Each year up until 2027. Now, coming to Chevron's return on equity and return on invested capital. Again, both metrics seem to be strongly correlated with the price of oil, relatively high when the prices of oil are rising, and low or negative when oil is losing value. As for net debt to EBITDA, which is earnings before interest, taxes, depreciation, and amortization, we like to see it under 1.5 for oil producers, and it's currently well under that threshold at 0.31. This means that it would only take Chevron less than 4 months to pay all the company's debt with their cash on hand. We see similar patterns for net debt to capital and interest coverage, with Chevron comfortably surpassing the preferred thresholds for oil producers, indicating a healthy balance sheet and a safe dividend. One last thing to check before moving on to the valuation models is how did Chevron perform in the last recession of 07-08, especially with the ongoing speculations of a potential recession looming in 2024. As we see here, Chevron actually increased the dividend during the recession. Its sales tumbled by 42.9%, which was below average growth, while the stock's decline of 34% actually beat the S&P, which declined by 55%. Jumping into our valuation models, we'll be reviewing 4 distinct models to get to our intrinsic value and acceptable buy price. If you're enjoying the content so far, please smash the like button and subscribe to the channel to ensure that you're notified once we release similar videos in the future. Our first valuation model is the discounted free cash flow model, where we estimate Chevron's intrinsic value based on the present value of their estimated future cash flows. One thing to note is that due to the cyclicality of the industry, it's almost impossible to accurately predict future cash flows, but we'll do our best to make reasonable assumptions using our current data. We can see here the free cash flow that Chevron generated over the last 10 years, growing at an average of 152.8% per year, which is really high considering the volatility that we observed in the financial data, but it does demonstrate Chevron's ability to continue to increase cash flow over long periods of time. Forward looking though, analysts are expecting a decline of -5 to 7% in their free cash flow, and to be more conservative, I decided to go with the higher end of that, which is -7% growth rate. Using an 8% discount rate, which is also our desired rate of return, we get the present value of all future cash flow, as well as our terminal value. Adding them together, plus cash and cash equivalents minus total debt, we get our enterprise value, which is the estimated total value of the company in 10 years. Dividing the enterprise value by the total shares outstanding, we get our fair value of $183 per share, which is much higher than Chevron's current stock price of $147. The second method is the multiples valuation model, where we obtain Chevron's fair value based on the multiples of its competitors in the oil and gas industry. We do so by getting their current PE multiples, calculating the average PE, and multiplying it by Chevron's earnings per share to get our fair value of $127 per share, which is lower than Chevron's current price, showing some signs of overvaluation. The third method is the dividend discount model, where we estimate Chevron's fair value based on the present value of future dividend payments, specifically used for dividend-paying stocks. We see here Chevron's total dividend paid per share in the last 5 years, which grew on average 6.59% per year. Now, given Chevron's dividend track record, it's very possible that they continue to increase the dividend at this rate. However, to be more conservative, I decided to go with a 5% growth rate for future dividends. Discounted at 8%, we get our fair value of $211 per share, which is higher than the current price. The last method that we'll cover today is the historical multiples valuation model, where we estimate Chevron's fair value by considering the normal PE ratios that the stock traded at historically. In our analysis, we'll use the 5, 10, and 20 years normal PEs. As we can see here, the Chevron stock was trading at an average 11.98 PE during the last 5 years, 20.36 for the last 10 years, and 14.73 in the last 20 years. We calculate their average and multiply it by Chevron's current earnings per share to get our fair value of $212 per share. Finally, to obtain our intrinsic value, an acceptable buy price, we take the average of the 4 fair value estimates generated by our models. The intrinsic value we get is $183 per share, which is higher than the stock's current price, but lower than its 52-week high. Without a margin of safety, the stock would be a buy at the current price. However, we always want to have a margin of safety to protect against downside risk. For high-quality companies with a wide moat, strong balance sheet, and good forward-looking data, a 10% margin of safety could be justified. With a 10% margin of safety, our acceptable buy price would be $165. So how do we determine the ideal margin of safety? Well, the short answer is, it depends. You must always consider the risks associated with the industry or the sector that your company operates in, as well as your risk tolerance to determine a reasonable margin of safety. When it comes to Chevron, the main risks are the volatility of the oil market, the global shift to renewable energy, which could decrease the demand on future oil products, and the risks of a possible recession happening in the near future. Therefore, you might want to consider a higher margin of safety. For a 15% margin of safety, the acceptable buy price would be $156. If you're looking for a 20% margin of safety, your buy price would be $147, which is just around the current price. If you want an even higher margin of safety, say 25%, the acceptable buy price would be $138, so it wouldn't be a buy today. In terms of Wall Street's expectations for Chevron stock, they're forecasting it to trade at $181 per share in the next 12 months, which is just under our estimated intrinsic value, implying strong potential upside for the stock from current prices. Now, I personally prefer a 20 to 25% margin of safety for Chevron stock. I do believe the company has an economic moat, a strong balance sheet, and an attractive dividend record, and I do own a small position in my personal portfolio. However, considering the risks that we just discussed, I personally won't be adding to it unless the stock declines to the mid-130s, as I think there are other available opportunities in the market with a more attractive risk-reward ratio. If you would like to learn about one of these attractive opportunities, make sure to watch the next video, which discusses an undervalued stock with great potential upside and 93 years of uninterrupted dividend payments. Let me know in the comments below your thoughts about Chevron stock. Do you agree with Wall Street's price target and our intrinsic value? Do you believe Chevron to be a strong buy at the current levels, or do you believe the downside risks outweigh the potential upside return? With that being said, don't forget to like and subscribe, and I'll see you in the next video.